It's 1 year to the day since ECB President Mario Draghi said he'd do whatever it takes to save the euro. That pledge has helped the currency, stocks and bonds all gain. But Europe's economy is still a mess. So should Draghi have been even bolder? Let's ask Arnab Das. He's the Managing Director of Research at Roubini Global Economics. Arnab, thank you very much for coming in to talk to us. So what's your verdict then, 1 year on how effective this seemingly off-the-cuff remark was in saving the Eurozone?
Well, I think I would agree with the comments that David was making earlier, right? I think Mario Draghi achieved what looked impossible 1 year ago today, and I think, he deserves adulation for having stopped the crisis, the financial part of the crisis, in its tracks. But like you were saying earlier, there's only so much the ECB can do. There's a big role for fiscal policy, there's a big role for structural policy, and above all, there's a big role for transfers and debt forgiveness, which aren't taking place and might not.
We'll get to some of those structural issues in just a moment, but even just on the financial impact, the impact on financial markets that his comments had. Okay, so they definitely took the stress out of Eurozone peripheral debt markets. Eurozone stocks have risen since. That's not necessarily to do with his comments, but that has happened. In terms of what's happened to the euro, though, it's still around. That's a plus. But it's risen 8% against the dollar since those comments were made. Some would argue that's actually to the detriment of Eurozone businesses. So do we give him a full thumbs up in terms of the impact on the financial markets?
Yeah, I would agree with that. The euro deserves to be weaker, needs to be weaker. Europe and the periphery in particular would benefit from that. But of course, you'd want the euro to weaken in the right way for the right reasons. Not because it might fall apart, but because cyclically it's weak, and therefore the ECB should be easing monetary policy relative to the Fed and relative to emerging markets.
So what's the biggest issue in terms of this lack of integration, the structural problems that face the Eurozone right now? What's the big one for you? What do they need to focus on? Banking union or something else?
Well, I think the biggest issue vis-a-vis what Mario Draghi achieved, the biggest internal challenge in that is that he created a kind of moral hazard where the necessary steps towards deeper integration have not proceeded, right? Banking union, which you mentioned, if anything, there's been backsliding on banking union because, the way I think to think about this is that during the extreme pressure that the markets were imposing
when
on the
everyone
Eurozone,
feared that the Eurozone might break up, or many did at least,
catastrophe mobilized political will to integrate. Removing the pressure and the risk of catastrophe, at least coming out of the financial markets, has lifted that pressure, and so now there's a different kind of moral hazard where national politics is in the dominance.
So is that, to some extent, do you blame the Germans for being a little less keen on banking union than they were maybe a year ago, or is it the peripheral Eurozone countries who need to do more quickly to do structural reforms in their economy?
All of the above. There's enough blame to go around for the North, the South, the creditors, the debtors, the policymakers, the politicians. Everyone's at fault.
Everyone. Okay, but you do have a solution, don't you, Arnab? You'd be so bold as to say that you have a solution for the EU, more demand in the North to offset a lack of demand in the South. Right. Is that happening? Is that something that's being pushed towards?
It's happening a little bit, sort of naturally, but there's not a fiscal push, there's not a strong enough policy push in that direction. The way it's happening is that wages have been rising in Germany relative to the periphery, where wages and prices have been collapsing in many cases, many kinds of wages and prices. So things are very slowly, little by little, moving in the right direction, but fiscal policy and structural policy is actually pulling in the opposite direction, right? Because although fiscal adjustment is necessary, structural reform is necessary, in the short run these things are bad for growth, bad for employment, bad for the countries in the maw of the crisis.
Well, I mean, so to what extent is the fact that the Eurozone economy is still in trouble, hasn't managed to regain growth, to what extent is that okay then? Because it's for a greater medium-term purpose, it's for a longer-term aim.
I think, I guess a lot of these adjustments are absolutely necessary. The real devil is in the details of how you sequence and achieve the adjustment. And the approach that's been taken has, if anything, aggravated the crisis all along, right? Initially it aggravated the financial crisis, which we've just talked about, and now what it's doing is aggravating the economic and social crisis, right? So, as you say, a lot of the benchmark financial asset prices in the periphery have improved quite a lot. But small and medium enterprises and households are not benefiting from that, right? They're continuing to suffer a depression. And so the big risk is that socially this is still unsustainable. And that's going to have political repercussions one way or another.
And we need to do more on these transmission mechanisms. Arnab, thank you very much for joining us today. Arnab Das, Managing Director of Research at Roubini Global Economics.